Hi guys, it's your mentor with the flu essay once more. So we are back again on another session, and today's session is about the difference between technical and fundamental analysis. So on the previous video, or let me say one of the videos, I defined technical and fundamental analysis. I was just passing by. I just said technical analysis is the approach to the market at any time of the week and using all the tools. So I just defined it as that was technical analysis. So yeah, and I said fundamental analysis, it's anything related to news release. So I was just passing by, but on this video I'll be going in depth now. I'll be going deep now in these two. Now I'll be differentiating the two so that everybody can fully understand the difference between technical analysis and fundamental analysis. So in technical analysis, we have price action and smart money concept. That's technical trading. So I'll be starting off by defining a technical analysis, a review. I said technical analysis is the approach to the market any time of the week and using all the tools. So tools I'm referring to, I'll teach you the 10 trend lines, whatever, how to use your everything, man. So it's using those trend lines, using your support and resistance, or whatever. Those are the tools. So okay, like I said, technical trading, it's about the price action and smart money concept. So I'll be defining what is price action. Price action is a methodology that relies on historical prices, open, high, low, and close, to help you make better trading decisions. Unlike forex indicators or fundamentals, price action tells you what the market is doing and not what you think it should do. So basically, what do they mean here? They mean that price action moves with price. You can hear by the word price action, so that it actually does. History repeats itself. So that's what they're meaning. History repeats itself. So they're using historical prices or historical data to determine the future data. So if you're using on the current price right now, you can analyze. After that, it tells you, it's like you after analyzing, you can able to tell where the market is going in the future, now in the next coming hours or days or weeks or months or even years or decades. So that's what price action means. We are moving with price. Where price is going, we are moving with it. We are predicting where price can go. So that's what they are telling us to do. So what to focus on according to price action. So price action the few key aspects that we focus on. So we have 6 few key aspects that people should focus on. So we have the market structure, nature theory, support and resistance, false breaks and proper breaks, false high and low, and probabilities versus probabilities. Those are the 6 main key aspects that you need to focus on as a price action trader. So people will say price action, some will. So okay, so the first one is market. I want you guys to note here. I want you to note something. I'll express it along the way, along the video. So the first thing, it's market structure. So market structure is how the market structures itself to move in a certain direction or cycle, whether up or down or consolidation. So like I said, I once spoke about an uptrend, a downtrend, whether the market is going long or short. So that's market structure. So I'll be doing more practicals. These ones need more practicals, but market structure, it's how the market structures itself, whether going up or down. Same as a person. Let's say you see a yard, but you see only the wall. Once you open the gate and go inside the yard, you find a house. So the house is the structure, is what you see. That's the structure, whether it's a double store house or it's a normal house. So it's like that. It's same as market structure. So I'll be doing practicals on the upcoming videos showing you market structure. So nature theory is the name that we give to the theory of the nature of the market, in which price behaves in impulsive or correction. This is the basis of how we trade and are some of the most important aspects of technical analysis. So basically, what do they mean here? It's that nature theory is how the market behaves, like whether it's going up impulsively or down impulsively, or it just moves in a direction that we are not certain. Consolidation means it's a price when it's undecided. So it's undecided. We don't know whether we're going up or down. We're just going sideways, So that's the nature theory. It's the theory that we place on price, on looking at whether it's going up or it's going down impulsively. Impulse means going up, like going up non-stop. Then a correction means going maybe up, then come a little bit down, that's correction, then goes up again. So it goes hand in hand with market structure, this one. So the next one, it's support and resistance. Support and resistance is an area on your chart where you can expect buyers or bulls to push the price higher or long. So that's support. Then resistance is an area on your chart where you can expect sellers bearish to push price lower or short. So in simple words, support is like the floor. Once you're inside the house, you are on the floor, you are on top of the floor. So once you're on the floor, you are higher now, you're going up. You can, let me say, for you to go up, you need a step ladder, right? So you just put a step ladder from the floor to the roof. So the roof acts as a resistance. The resistance acts as a roof of the house. So let's say you have a house, then the resistance is what? It's the roof. Once you add the roof, you can come down. So you want the roof, it's on top right now, you see. So that's the resistance. Once you are at the roof, you can't pass the roof. You can't pass the roof, or you can look at it, or the ceiling. You need actually a hole so that you can pass it. So that's support and resistance. Support is the below of the market, and resistance is the upper level of the market. But I'll do these things practical so that you can understand. So the next bullet, it's what false break and proper breaks. So false break is when the market doesn't respect a setup you have implemented and gives you a false indication of a direction. So and proper breaks is when the market respects your setup by giving you a proper indication of where the market is going. So false break is the same as giving false alert. So if, let's say, now you enter what yo squasa chaba, English is it's something else. So yeah, you are expecting, let me just put it in simple English. Let's say you're expecting the market to push up, but you find that it was a false indication. So you'll see by long wicks and rejections, you'll see by it doing a breakout. After doing a breakout, then you expect it to push much up, but then it happens that it goes the opposite way. That's a false break. And a proper break, it's actually respecting your setup. Let's say you're expecting a buy and it follows that buy. That's a proper break. That means it continues in the direction that you anticipated. Yes, that's the word I wanted to say. Anticipated. Thank you. Yes. So false high and low. False high and low goes hand in hand with market structure. Is when the market creates false market structure, whether down to up or up to down. So false high, it's that's false low. False low, it's down to up. So that means that a false low, you find that the market rejected where it was going down, then came back up, then went up, and we were expecting sellers. We were expecting the market to go down, so it just turned all of a sudden and went up. That's the false high. That's the false low. Then the false high, it's the market going up, then turns all of a sudden and goes down. So we were expecting a higher high, but then the market rejected the price. So yeah. So the next bullet, probabilities versus probabilities, is when it's up to the market to decide whether it's gonna go where it will favor you or not. Same as coin theory. So to simplify, what they are saying here is that trading works with probability. It's all about probability. So let's say now you're anticipating a buy. So remember the coin theory. Let's say use the coin theory. Remember the coin has tails and heads. So let's say now you're saying I'm expecting heads, then they flip the coin. Once it comes, then it comes in heads. You're expecting heads, then it comes in heads. So that means that the probability for it to turn heads, it's there. It's 50%. And the probability that it can turn tails, it's there. So If it favors you, let's say heads, then it goes in heads, you won. But if you choose heads, then it goes into tails. It opposes you. Remember, it's a game of probability now. So that's what you need to understand. It's probabilities versus probabilities. The probability that the market can respect what you have stated, respect your theory of whether it's gonna go up or down, is the same probability that it can disrespect what you have said. Let's say you implemented the theory that it will go up. According to the setup tells me that the market has to push up. So that's what the probability again. So then it disobeys. So it's just the probability as it is. It's not like when you analyze and you expect the buy, it will favor it. No, some expect the sell through that same setup, you know. So it's a probability, or it's a theory that we implement. Then it's up to the probability whether it goes in heads or tails. So yeah, I think I'm done with price action trading. Yes, that's price action trading. So now let's go to smart money concept. That's what I like. That's what I use actually to trade. Smart money concept, because I understand it more deeply and it has more reasoning capacity. You know, smart money concept, some they say it's SMC. Remember, shortest way out. So what is SMC? SMC, smart money concept, is a state of trading where we predict the probability of how the central banks, institutional or market makers will move the market, or how they make their move. So remember, the market, it's moved by central banks. The main players for the market to move is by big banks, central banks. You can search them. The Bank of States. I remember. I forgot their names, but you can check the big banks of each and every country. Every country has a big bank. So yes, those are the people who move the markets actually. Remember, the banks are trading, not Capitec, FNB. These are smaller banks, but they actually trade also. So there we have big banks, you know. So yeah, so let's go deep into it. Smart money is based on supply and demand, because as we know, the market is also about supply and demand, not about support and resistance. And we know that the market is moved by central banks, not by support and resistance or trend lines. If one can understand what is supply and demand, they can understand what is forex and can understand SMC. SMC is the same as technical trading, because we analyze where price might move or where they are headed. So in simple terms, smart money works with the definition of forex. That's why I like smart money concept, because smart money concept speaks about supply and demand. The market, that's the market. That's actually forex trading. Forex trading is supply and demand, nothing more, nothing less. There's no difference. Smart money goes hand in hand with the definition of trading. So definition of trading is supply and demand, easy as that. So once you understand what is supply and demand, then you'll know what moves the market, and you'll know how to trade actually, with understanding of why the market has to go up, why the market has to come down. It's because we have a demand down there. Why the market has to go up is because of a certain supply. So that's what smart money trading is all about. So in simple words, supply and demand, let me simplify it. So in simple words, supply and demand leads to targets, price action, stop losses, get in a trade after price action, SLs are hit, then in other words, liquidity grab, then go to imbalances, move with the institutional banks. That's how smart money trading works. So in simple words, what I'm saying here is that like I said, smart money is about supply and demand. So we start off by supply and demand. So where these price action traders have put their stop losses, it's actually a liquidity grab. So because they know that they are about supply, support and resistance. So I'll explain and show you examples. So smart money, we know that where retail traders put their stop losses, it's actually where we're gonna enter. So after the market has took their stop losses, took their capitals, that's where we enter. We enter on the safe side. So after that, we feel the imbalances, the insufficient price action. So then after that, we move with the institutional banks, because remember, we know that the market moves with supply and demand. That's it. So that's why we say we move with the institutional banks. And remember, there's no strategy that's accurate now. So nobody knows where the market will land or stop besides the central banks. They know how to move the market. They know that this pair has to stop here and go there and come back. Nobody knows that besides them. So yeah, but we can say with smart money trading, we are 95% to 99% accurate, or let me say 98% accurate, that we but we can able to predict where the market makers will make their next move. So yeah, and our theory can be 90 to 98% accurate. So yeah, so these are the concepts to focus on smart money. These are the concepts that we're gonna focus on. So we have market structure. Remember what I said? I think a few minutes ago I said notice something. So market structure, guys. Market structure is key. Understand market structure. I'll be preaching about it. Market structure is the king, guys. Once you master market structure, you are done with the market now. So yeah, market structure, liquidity, supply and demand, IPA, FVG, imbalances, session trading, psychology. These are the aspects you're gonna need to become a successful smart money trader. So these are the aspects you're gonna need to be successful in the smart money world. So I'll be explaining them deep. What is market structure? I'll be showing practical example. Liquidity, what is liquidity, supply and demand, all those kind of things. Yes, and the psychology required for you to become successful in it. So yeah, so I think I'm done with technical trading. If you don't understand, my DM is open. Yeah, so let's go. Fundamental analysis. So guys, whether you are a smart money trader or retail trader or a indicator trader, moving averages or whatever, you're gonna need fundamentals, no lie, because you'll see by them. Once I explain, you'll understand that the fundamentals are the ones that are moving the market, not your trend lines, not your smart money. Your smart money is not moving the market, not your order block is not moving the market. The only thing that's moving the market is fundamental analysis. That's it. So fundamental analysis. What is fundamental analysis? Fundamental analysis, anything related to the news release worldwide, and it is the process of breaking down the impact of political, economical and social factors on the relative value of a currency. So let's say a country experiences a pandemic, so like coronavirus. What happens? The currency struggles, it loses value. So in these kind of things, that's where fundamental analysis comes in. It's anything related to news release. So you can see that even a small thing, a natural disaster, can actually affect a currency. Like let's say South African rights, or let's say at America there's a war, like Ukraine and Russia war. So you can see how it's affecting the market, not the market alone, but also globally now. So you can see that many countries are about to hit a recession, and we all know that once a country hits recession, it's bad. So you can see that now those factors are affecting the market. The stocks have been crashing. We have cryptocurrencies like Bitcoin have been crashing, all due to what? To fundamentals. Only due to fundamental, not because of a trend line or not because of liquidity or what. No, it's because of what? Of factors like this. So fundamentals, you need to know them. It's compulsory, guys. Once you know fundamentals, you can able to trade now. You just look for an entry to follow the trend actually. So I'll be able to explain more on the other videos. So the market is moved by three fundamental, which is central banks move them each and every day. They work daily basis. So it's the main player. Geopolitical factors, the Ukraine and Russia war. That's it. That's the geopolitical factors, recessions, those kind of things. Like let's say pandemics like corona and things. So yeah, and economic data, these ones are temporary. They happen every week for a certain time, just for maybe the next 5 minutes it will happen, then the market goes back into its normal conditions. So yeah, let's go. Central banks, the main player now. So central banks, it's interest rates and the monetary policies. These help you to determine the trend or the direction. In most cases, they are based on real-world events like BRICS, GDP, inflation, deflation, etc. So these ones, interest rates, monetary policies, are just easy things. GDP, it's gross domestic product of a country, inflation of a country, deflation of a country. Then we have for you to able to get updates of it, you need to use central bank sentimentals. They are being released, these kind of things, but people ignore them. Then they end up losing funds over silly things. So once you read these central banks sentimentals to guide you for trading for the upcoming months, it's like the prediction of what's gonna happen, and they actually happen, guys. So you need websites like Bloomberg, CNBC, Investing. They release these statements. You just read them or get the PDFs. Yeah, that's how you do it. So yeah, the second one is geopolitical factors, are global issues happening worldwide which affects the market, whether positive or negative, e.g. wars. That's what I was talking. The current situation that we are facing, wars, the Russia and Ukraine, trade relations, pandemics, the corona, recessions. These are factors that have ability to strengthen or weaken a currency depending of the weight of the factor. So these ones are actually strong. These ones, geopolitical factors, trade relationships are not that hard, but pandemics, recessions, wars, they affect the world globally, So these ones are hard, like pandemics. You saw how corona did to us. It didn't do it physically, but also in the markets were affected. So mostly in geopolitical factors, investors, if let's say USD, let's say the dollar is having a recession, so it's experiencing a recession, investors pull away their money and invest in pairs like gold. So gold doesn't lose value, whether the pandemic anything, whether recession or what, gold will never lose value. So investors move their money to safe haven currencies. We call them safe haven currencies. So safe haven currencies are currencies that, whether there's a pandemic or what, I forgot other currencies, I forgot them. So gold is one of them. Gold doesn't lose value, whether there's a war, whether there's bombings, war, whatever, corona, it will appreciate. That's even the perfect time to invest in it. So investors take their funds and put it in safe haven currencies, so they know that they'll never lose their funds in cases like this. So yeah, geopolitical factors, to get the best way to get updates for such events, one must have apps or visit websites of news updates like Bloomberg, Forex Factory, Investing, CNBC, etc. You can search them, news sources for forex trading, but I recommend Investing and Bloomberg and CNBC. Forex Factory, for me, it's a bit complicated, but the one that simplifies things, it's Bloomberg, once you pay the premium one especially. So it's much simple. You just have to put normal sense to it. Then Investing, so yeah, I'll be teaching you how to use your Investing app to get economic data and just like that. So okay, let's go. Economic data are short-term effects that happen in a month and causing short effects and making the market volatile for a short-term events. Events like PMI, retail sales, CPI, etc. I highly recommend Investing app for an individual to see these events or get updated every day for these events. These events happen every day for 5 days a week. We have those small nyana events, they cause volatility. Those are the factors that cause volatility in the financial markets. So I'll show you how to able to see those events. You need to check your investing each and every day for those events. I'll be indicating them bit by bit, because I'll be indicating them. So yeah, so far that's the difference between technical and fundamental analysis. So if you have any questions, my DM is open. Y'all know the vibes. But so far I hope this theory everybody understand it. So from me to you guys, your boy out with the flu SA, sending out. So catch you on the next lesson, and I'm out, guys.